Delta hedging is a strategy used in options trading to reduce or eliminate the risk associated with price movements in the underlying asset. In simple words, it means adjusting your position in the stock or asset so that small changes in its price do not affect the overall value of your portfolio. The goal is to stay neutral to price swings by balancing the option's exposure with an offsetting position in the underlying. The idea comes from the concept of delta, which is one of the so-called Greeks in options theory. Delta measures how much the price of an option changes when the underlying asset moves by 1 unit. For example, if a call option has a delta of 0.5, that means if the stock price rises by $1, the option's value increases by 50 cents. Traders use this sensitivity to calculate how many shares they need to buy or sell to hedge. Here's a simple example. Imagine you sell one call option on a stock, and that option has a delta of 0.5. Each option usually controls 100 shares, so your total delta exposure is plus 50 shares. To hedge, you would sell 50 shares of the underlying stock. Now, if the stock moves up or down a little, the gain or loss on the option will be offset by the opposite move in the stock position, leaving your portfolio roughly unchanged. That is the essence of delta hedging. But delta is not static. As the price of the underlying changes, the option's delta also changes. This is where things get tricky. A call option that was at the money with a delta of 0.5 could become in the money with a delta of 0.8 if the stock rises. That means your hedge is no longer perfect, and you have to rebalance by selling more stock. This constant adjustment is called dynamic hedging. Professional traders, hedge funds, and market makers do this all the time to manage their risk. Delta hedging is especially important for institutions that sell options, because selling options exposes them to potentially unlimited losses if the market moves strongly. By delta hedging, they can protect themselves from those movements and focus instead on earning the option premium. Historically, delta hedging became prominent with the development of the Black-Scholes model in the 1970s, which provided a mathematical framework for option pricing and hedging. The model assumes that continuous delta hedging is possible, meaning you can always adjust perfectly. In reality, markets have transaction costs, liquidity limits, and sudden jumps, so hedging is never exact. Still, the principle is the backbone of modern derivatives trading. A curiosity is that during market crashes, delta hedging can actually amplify volatility. When markets fall quickly, option sellers need to sell more of the underlying to maintain their hedge, which can push prices down further. This feedback loop has been blamed for worsening events such as the 1987 crash, when portfolio insurance strategies based on dynamic hedging contributed to the speed of the decline. In conclusion, delta hedging is the practice of balancing option positions with trades in the underlying asset to stay neutral to small price moves. It is a cornerstone of options risk management, combining elegant theory with the messy reality of fast-moving markets. Above, you can find more videos to keep learning about law. Remember to give us a like and subscribe.